Welcome and happy new year to Bar Charts Market and Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. And as we left off at the end of last year, we identified a potential buy the dip opportunity. But, we needed until this week to confirm the setup. And a change of character in our longer term timeframes continues to put doubt, or at least tells us to be patient. Quantum stocks got an ice bath today or this week, and Thomas and I will share some of our thoughts on where the S&P will finish in the year 2025, and I'll offer up some trend ideas and a few select stocks that I think we should keep our eyes on. All that and your questions, which have been piling up for 2 weeks. And as always, to help me out with that is my co-host, Mr. X, Thomas. Hello, Thomas.
Hello, John. How are you?
I am doing well. I know that you're on the opposite end of the world, aren't you?
I am in Bangkok, John. It's a beautiful 3:30 in the morning here. I woke up specifically to do Market on Close with you, so I hope everybody's extremely grateful for that, John.
I know I am, buddy. I know I am.
All right, so we got a ton of material. So, guys, we're going to jump in a second. Just want to give a quick reminder for those of you watching directly on our website. If you want to ask a question, just click Ask a Question at the top right. You'll see it in the orange color. And then for those of you watching on YouTube, just go ahead and ask those questions directly in the chat, and we will get to as many as possible. All right, John. So something bad happened late last year and early this year. And it's the first time it's happened in more than 7 years, and that is Santa Claus has abandoned us, John. Not something I thought it would happen again, but it did. Now, again, to recap, the Santa rally period, John, is the final 5 trading days of the year, followed by the first 2 trading days of the following year. Now, on our last show, John, you talked about the possibility of a change in character occurring in the market. Now, I didn't quite believe it at the time, John. I kind of wanted to see the price action kind of dictate that, and it might be happening. Do you still think, or do you feel that a change of character is finally taking hold of the market?
Yeah, I don't think, and I don't feel. I know the market has definitely shown a change in character. Now, there's a big difference between is this the beginning of a downtrend or something more ominous? It just is telling us that the long-term trend has kind of maybe paused, that maybe we're due for, a little bit of sideways action. Here's the reality of markets is that they spend more times in what we would call sideways trends, or, really prices just facilitates between, the small range for longer periods of times than we are actually in a trending period of times. And we have trended now for a very strong, on or off for about, 2 or 3 years. And, we're talking about plus 20 gains. But here's the S&P Spider, the ETF. And this is what we were kind of talking about. What's change of character mean? What does that mean? Well, what's the characteristics of an uptrend? Well, that's higher highs and higher lows. What's the characteristic of a downtrend? Lower highs and lower lows. So a change of character would say that whatever the dominant trend is, that they're starting to see the opposite effect. In other words, in an uptrend, we might start seeing a beginning of lower highs and lower lows. And that's exactly what we have been doing. Now, we did notify last time that we thought there was this kind of head and shoulder-ish as well. Now, it doesn't mean that's the end of that trend. It just means that trend maybe needs to regather itself, and then we get a little bit of a rebound out of it. And so last time we were talking about that there might be a potential buy the dip opportunity when we had this, several days of down trading action. And I said, well, let's look at this in terms of a higher time frame, weekly. And what we were looking for was an acceleration on the downside, but this opportunity where price is going to hold a level and not break structure. In other words, hold, let's say, a higher low. And we were seeing that potential happening, a couple of weeks ago. And I said to you, well, there is one candlestick pattern, a 3-candle drop, that if we see this, we need to wait for that green candle to develop and then waiting for from the next point the following week to give us that buy signal. So if I go into, let's say, I want to kind of just recap this for us. So let's go back to S&P sectors, and I want to go into the charts here. And so I'm going to kind of want to show you what I was talking about. So here is the energy sector. And again, let me change this to a weekly. And there's that 3-candle drop. 1, 2, 3. The acceleration around. There's that green candle. And then there's that green candle buy signal. So the energy sector gave it to us. But if we look at for so late in, say, industrials or materials, we didn't get that. As a matter of fact, we found a pausing in the market, and actually we're now lower from there. So this is really kind of telling us that we are starting to see a change in character. Now, let me just go back to the S&P, the SPY. So the next thing that we need to be aware of is something called break of structure. In other words, we have a change in character, but as long as we hold structure, as long as we hold a higher low, or the market doesn't fall too far, take out a couple of intermediate lows, then we should be all right. Now, what we are seeing here is lower highs and lower lows, change of character. And I would say that the 585 level was probably a minor structure level. But here's where I think the market needs to break structure to tell us that, yes, this uptrend is over. And maybe what we're starting to see is the beginning of a corrective downtrend. So if I change again this to a weekly, and we look at this, see that break of structure is on a weekly basis is right around this green candle. In other words, the last low that we made in this uptrend. So yeah, we have changed the character of our markets, but we haven't broken structure. So Thomas, there's still hope that the market will hold and go higher, anywhere between here and, let's say, this, in this case, the 571 level, which, by the way, would be a 38% retracement, a great place for a strong uptrend to hold in a correction. Below that, then we need to start talking about some other things.
Okay, John, that's great information and a lot of really good points for us to look at and see what happens over the next few weeks. But let's kind of take a bigger kind of look at the market, John, and try to figure out, what's going to happen this year. Because I think a lot of people, especially like those medium to long-term people, are less concerned with the weeks that follow and more concerned with the years that follow. Now, John, throwing out price targets for an index a year ahead, even 6 months ahead, a lot of the times is a fool's errand. I mean, Wall Street has been a horrendous performer. I'll remind everybody, going into 2023, Wall Street was entirely bearish on the market. They got it dead wrong. And last year, going into the year, John, the average prediction was about 4,900, and the S&P 500 blew those predictions out of the water, finishing just below 5,900. So, guys, John and I are better than Wall Street. There's no doubt about that. But don't hold us to an incredible standard. We're just doing our best here. We're kind of throwing darts at a board. Now, John, I'm going to throw it your way because nobody cares what I think. They care what you think. You've got your finger on the pulse. Where do you think the SPX finishes 2025?
Well, I think we come into this year with a lot more risks than we had last year. And so I think that we have to take a little bit of a cautious view. And again, I was one of the ones last year that actually felt that the market had some issues with it. But again, the market tends to outperform. I don't care what metric you look at, market metric you look at, let's say, for instance, forward PE or the Cap-Shiller ratio or yields on stocks, or, all of these are giving us historical warning levels. And so I think we have to take notice to that. But, the risks that I'm thinking about, fiscal, monetary risk, potential global recession, I really do think that outside of the U.S., a lot of other economies are doing poorly, especially in places like China and Europe. So I think that's going to lead to a lot of the volatility this year, increased in volatility. So, Thomas, I think that, again, I'm not a one to make predictions, but if I kind of like to look at things in terms of probability, I think there's a 50-50 chance that we will see a 10% or greater correction sometime this year, and that there's a 1 in 4 chance that we'll see a correction of 15 to 18%, and a 1 in 10% or 1 in 10 probability that we'll see a correction of greater than 20%. So that in mind tells me that I think the market's probably going to go down first. And then I think then the market will recover, digest, and then do a little bit of rally. Now, again, if we look at valuations and a lot of our stocks that have been leading, you cannot argue that they are very highly valued. So I think in terms of earnings, which is really kind of what drives the market, I think we might need a year or two, or maybe even 3 years of these earnings gross to catch up with the prices of these stocks. So again, I'm not a big prediction fan, but I think if I had to put a number on the S&P, somewheres around my number would be, and I thought I'd put this number out here, but let's put it up anyways. My number is going to be, for this year, 6,050. I think that's where the market will finish. So a slight gain, maybe around 3% from where current prices are. Maybe on the potential on the upside of another up to about 5%. That's where I put. If I was looking at, let's say, was it the INXX? Is that the? Yeah, there it is. INXX. And NASDAQ Industrial. Was it 22,000? I would say, well, that's the index. It's industrial index, excuse me. I think it's INXX. I think something like 22,000, 22,500 would be my number for that one as well. Okay.
So, John, there's a lot of people right now that are very depressed that your number is coming in a bit lower than they might ideally be used to, right? Because the last few years have been an incredible run.
Yeah.
For the S&P 500, and it's hard for people to realize that we may not get those large gains. But, John, I've got a slightly different take.
I know you do. That's why I love you, brother.
I've got a more bullish take.
There's IUX.
I agree that in the short term, a change of character might be sort of taking grasp of the market, but I still am in the firmly bullish train for the market over the longer period. Now, I was trying to think last night, John, of what I might put as a price target for the index, because I was kind of bouncing around between, a few different numbers between 6,500 and 7,000. And I came across an interesting data point, which is that over the last 48 years, John, when the S&P 500 finished the first 5 days of the year in the green, the SPX would go on to finish the year green 83% of the time, with an average gain of 14.2%. And I kind of, I took stock of that. And I thought, what, that makes sense. I like that. It's kind of in the ballpark of where I was thinking initially, John, kind of in that middle range of 6,500 and 7,000. So when you use this number, this fact, my prediction for 2025, John, is 6,717.
Okay, hang on. Let's change that. What'd you say it is?
6717.
6717. Is that what you said?
You got it.
All right. I'm going to put them on our charts, and let's see if it's up there. Woo! Nosebleed. We'll see. We'll see who does well and how this plays out come on a year from now. How about that, buddy?
That sounds good. Now, I want to hear, we know what you think, John. We know what I think, but I want to hear what our audience thinks, because I really value, John. I mean, if you're smart enough to sign up for Bar Chart, John, I really want to hear what you have to say about the market. So If you guys want to leave your guesses, please do so. Go to our YouTube channel, pull up the Market on Close video, and in the comments, leave the number for where you think the SPX finishes 2025. I'm really curious, John.
I am too.
Hear what everybody thinks. I did do a poll on our X account, John, which I'm going to show at the end of the show, just to let everybody see kind of where people are thinking for the 2025 prediction. So, all right, so that's fun, John. Now, let's switch gears a little bit, John, and kind of dive into a topic we've talked a lot about, which is small cap stocks. Now, we've thrown out tons of predictions, John, tons of, I guess at this point, it's hopium on small caps, talking about these lofty nosebleed numbers that small caps might rally to. And it's just not happening. So the question again, John, because we're seeing more predictions. Tom Lee from Fundstrat, he's sticking with his bullish predictions for small caps. Here's the question for 2025. What is a more promising group of stocks? Is it small caps, which we've talked about before lots, or is it mid caps, which is a group of stocks that, to me, John, it feels neglected because nobody's really talking about mid caps. But is the fact that nobody's talking about them reason to be optimistic on them?
I think that's exactly what it is. That's the way I kind of feel about it. So let me show you guys a chart here. There we go. So on the right here is the IWM. This is small caps. And this is a weekly chart. And on the left here is the IWP, which is the Russell mid-cap growth. So I kind of wanted to do apples and apples instead of picking maybe another mid-cap. But, the narrative for the last year and a half or 2 years has been that, a lowering interest rate environment is going to be good for small caps. And you can see from about October of 23, when that narrative was starting to be constructed, then we got that big rally. Look at the IWM went up about 51% on, that kind of that narrative. And then what happened was, we came around and Fed's kind of saying, well, we're going to cut a couple times this year, end of last year. And that, we're going to take a wait and see attitude. And that kind of put a shock into the small caps. And from the high that we reached, you can see that we're down about 12% from that high. Now, that's just a normal correction. So that's not too much bad of an idea in terms of an opportunity. But if we look at the mid caps over the same period of time, we can actually see that, mid caps actually outperformed small caps during the same period. They outperformed them on the upside and they outperformed them on the downside. So I think that moving forward, regardless of what the market is going to do, depending on its relationship to interest rates, I like mid caps. And the reason why is because like in the IWM, 40 or 45% of the stocks that are in the IWM are not making money, or sometimes referred to as zombie companies, where that percentage in the mid cap is only less than about 15 to about 10%. So you get more profitable companies in there. So that's kind of what I want to look for, and that's what I believe in. So looking at that opportunity. Now let's go to dollar IDX. Try to keep all these symbols in my head, Thomas. I feel like I'm losing my mind.
Yeah, we need a poster up on the wall, John, I think.
So what I want to do here is let's do this. I want to go to, hang on a second. I'm just going to think where I'm at. Yeah, let's do this. S&P. There we go. Mid caps. Yep, there it is. Okay, so these are all the stocks that are in the mid caps, all right? There's 400 or so here. So what I'm going to do here is I'm going to sort these by one of my custom views. And when this custom view, the main one I really want to look at is, what industry groups, but also, let's look at, let's say, the performance over the last month. So again, let's kind of look and see first, like who is doing well, and then what industries are they in. So notice what we see here: oil, energies, oils, um, medical devices, right? Medical devices. And then, if I scroll a little bit farther down, I see, high-end retail. And then I'm going to tease with something we're going to talk about later in the segment about that there's this bifurcation among consumers, and the wealthier consumers, it doesn't seem like there's a recession, or they're not being affected by higher prices. And so a lot of these high-end retailers are doing very, very well. So the point being here is that if you're looking at mid caps and you're not interested in some of the ETFs that you can trade in, I would be looking at some of those energy stocks, medical devices, and high-end retailers. Now, if you're thinking about you still like the small cap story, well, again, what I would encourage you to is think about, make sure that your small cap is making money. So, think about, looking at their free cash flow, or, make sure that they have a series of quarters of, positive revenue. So avoiding some of those potential zombie companies are going to have difficulties if we do not see a reduction in interest rates, which, as of what we saw this week, doesn't feel like that's coming anytime soon, does it?
No, it definitely doesn't. And John, I was going to save this for the end, but since you brought it up, there was a question we got, which is, why did the market react adversely to good employment data this morning? Well, the reason is because rate cuts are almost certainly off the board now for the foreseeable future. There's no reason for the Fed to cut rates right now.
Right. That is only going to accelerate or heighten the potential for a return of inflation. And that's not what the Fed wants to do.
Yep, exactly. All right. So, John, let's talk about somebody who has taken on cult-like status, hero worshiping status, and that is Jensen Huang.
Mm-hmm.
Now, Jensen Huang, definitely one of the brightest minds probably in the world. He's made me a lot of money on Nvidia, John. He's made a lot of people a lot of money. But what he giveth, he taketh away, John, because the other night, he was presenting at CES, and he just single-handedly destroyed quantum computing stocks. He said at a minimum they're 15 years away and potentially as many as 30 years away. Now, John, I might still be around in 30 years, but I don't want to wait 30 years for my investments to pay off. I'm a long-term investor, but that's a bit beyond my horizon. Now, previously, John, and you've talked about it quite a bit, which is a quantum computing stock, IONQ, which has done extremely well, John. In fact, a lot of people were thanking you for the pick, saying, "My gosh, thank you so much. I made a lot of money on this." John, in light of what Jensen Huang said and his minimum 15-year viewpoint on quantum computing stocks, where do you stand now with the industry, the group, and specifically IONQ?
Well, let's start with IONQ, because I do feel like that it's my obligation to talk to you guys about, this was a stock that we identified, and as you pointed out, folks jumped on that bandwagon. Although I did not enter into this trade, it ran away from me. I had a trade plan, and I didn't, FOMO. I didn't chase the market. The market never gave me the opportunity. It gave me one opportunity, but actually I missed it. But here's about around the time where we started identifying this momentum in the quantum stocks. So you can see we had a nice double on this one. But as a trader, and this is really important for a point for us, I think this is a really educational point, is that a stock goes up a double, you got to have some kind of risk management in there, and one of the things we talk about is soft stops and hard stops. Now, a soft stop could be a combination of things. So it could be, let's say, a percentage from the most recent high, something called a chandelier stop, or a percentage or a dollar value from your maximum gains. Or, one of the things I kind of use is if the market takes back the original risk that I was willing to take in a trade. For instance, if I was going to come in around $22 and risk $3 to $19, then if this stock took back $3, I would be doing some type of risk management. But we also talk about something called a hard stop. And a hard stop is kind of protect us from catastrophic events exactly like this. Now, we have a screener. This is what I call the end of the road. We have a screener in bar chart. It's called the end of the road screener. And if you go down here, where is it? There it is, end of the road screener. And this is going to identify stocks that are actually doing exactly that, where they fall from after, a nice rally. So it's important for us to have, some kind of risk management. And I would like to have a hard stop at a very particular level. Now, where that would be, again, if we think about character of the market or break of structure, where is the last significant low? Now, what I like to do is I have what is called the 3-candle count back method. And let's say here's a weekly chart. And so what I'll do is whatever candle I'm on a weekly candle, I'm going to count back 3, 1, 2, 3. And that's where I'm going to set my hard stop. So you can see that I would have been stopped out in IONQ. So is there an opportunity to get back in this market? I think there is. I think, Thomas, I don't think quantum computing is going away, but I do agree with you that there is, it might take a while. Now, I actually did end up doing some research in this after this stock had this nice run. And here's a watch list of those candidates in the quantum field. And what I discovered was actually the leader in quantum physics or quantum computing is IBM. They actually have like 20 quantum computers. But, to try to pick which one is going to be the one that's going to be the outperformer or the one that's technology is going to advance the fastest, it might be very difficult to do it. These folks that are in this sector are telling us that some of the benefits will actually come within this 3 to 5 years. So that is definitely in an investor's window. So here's my point. If you made money in IonQ and you got stopped out, congratulations, good job. Well, maybe what we might want to do is reinvest that money inside of this ETF, this quantum Defiance Quantum ETF, which is nice because I went to their website and let's see, I got to go back to it now because I accidentally canceled it out. But here, I'll show you how you can do that. You go into basic funds, and then here's our Defiance ETFs. There we go. And if we go down and look at, I'm miss here. Let's see where we can find it. All right, thematic. See what we got. Here it is. Okay, there we go. All right. Sorry about this, Thomas. I know I'm going a little bit over. We're going to shorten the next segment anyways. And we look at the holdings. So this is kind of like an equal-weighted technology fund. And it does have a kind of a weighting towards some of these quantum funds. But look at some of the companies in here. Marvell, Taiwan Semiconductor, Tower, ASML, Applied Material, June. So this is a really nice little tech fund. And what I like about it is that it's kind of equal weighted, and you don't have that single stock weight risk that we see in like a lot of other technology ETFs, where Nvidia is like the number one holding. And again, if you look in here, you got IBM and Honeywell and a lot of these other companies that are on the leading edge of quantum. So I think there's an opportunity for us. If you didn't put in a stop in INQ, you're lucky. It has bounced back, but this might be a dead cat bounce. Certainly, I think where the low is over the last couple of days, that's where I put my hard stop and protect myself from giving back all those nice gains that we got in this really nice trade, right?
Yeah, exactly, John. Great information there. And just want to let everybody know this show is going to run longer, so stick with us. We're still going to do our 15-minute Q&A, so we're not going to leave you guys hanging on those. I do see a ton of questions that came in today.
All right, I apologize, but it's been 3 weeks, so we got a lot of material to get through.
Absolutely, and I think people love that. So, all right, John. So on Wednesday, John, you did your weekly webinar. You talked about trends and themes that people might want to watch and pay attention to this year in the market. Now, John, a lot of people, myself included, don't always have 1 hour to sit and watch a webinar. So if you could recap that, John, for our audience, and also maybe talk about specifically a few stocks or ETFs that you think are your best picks within those themes, that would be amazing.
Yeah. So the webinar, basically, we talked about um, a few trends that I want to look at this year, and the one is that is the continuation of the trend that's been driving the market, and that is AI. There's kind of this ripple effect of this disruptor, AI. So we've moved from chips and semiconductors to data center build outs, and the focus is now becoming software. First, security software, but I want to start looking at software in what I call the package software segment, and then also the data processing segment. So let me kind of give you some ideas. So let's go into investing. Again, AI stocks. And again, I'm going to sort these by industry. And so again, and these IT services, I think these are the ones that I'm kind of going to be looking at. Um, if I go down a little bit farther into the computer software, right? For instance, like in Salesforce, if I go into Salesforce and I look to see what sectors or industry groupings it is, it's in the prepackaged software. So I want to look for some candidates that are in here as well that have AI connections. So there's a lot of them in there. And one of the ways you can do is look for alpha or looking for how it does over a certain period of time. The other one would be data processing. So let's see, DT. ST, data storage and processing. And again, this one is in that processing data storage level. And one of the ones that I found in here that kind of intrigues me is this one, Pega Systems. And let's look at the chart real quick. So again, I don't know which one is the one that's going to do, but here's Pega. It's been in a nice uptrend. It's upsloping 200, 100-day, 50. It's hanging around the 20-day. It's still above the 50. Now it's come into an area of resistance, so maybe it needs a little bit of a breather here. But, maybe I'll look for a dip buying opportunity in this one, or I'll wait for a breakout. So that would be one thought. The other thought was, that data centers, the build outs are one-time expenses, but the power consumption is ongoing. And matter of fact, the CEO of Microsoft said that, they have enough chips, they just don't have enough power. So one of the things that I went into our investment segment and looked at under the clean energies. Now, this is a little bit more ripple-ish, another way. Certainly, nuclear stocks have done well. Look at Constellation today; it was up like $50, and they have nuclear. But we did a webinar in May with an insider in the industry grid, and he told us that the grid cannot grow without solar, and solar is the largest segment of renewable power, and he was just big on solar. So I think that solar is going to be the opportunity. But again, if I sort this by sectors, and we got solar here, solar has really been beaten up basically, and there might not be a great opportunity in this. But if I go into performance and I sort by weighted alpha, there is a solar company that is not so bad, and that is First Solar. And First Solar is the only U.S. domestic solar producer. There are solar producers, and panels are made all around the world. Most of them are made in China. So if Trump brings in China tariffs, they will be buffeted from it. So I think they will benefit from them. And again, if I look at their chart, yeah, it's not ideal for me as a long-term investor, because we're below the 200-day moving average. It's something that I kind of hold to. But if I could get the 20-day moving average to cross over the 50, or the stock to recapture the 50, both of those at the same time, then maybe there might be a momentum trade in here, maybe buy some 200-day moving average call strikes. And then if the stock does perform, then let those stocks go higher, that stock go higher, and then exercise that 200-day moving average. And then the other theme is a aging demographic, which is, by the year 2030, 25% or 20% of the population is going to be 65 years or older. And so we looked at several segments. So I'm going to skip, and I'm just going to go to what I think is my best pick. But we talked about senior living, quality senior living companies that are in there, travel and leisure. This is the most wealthiest age group or demographic group in the history of whatever. So they're spending money, and you can look at those stocks we talked about. But I want to talk about end of life arrangements. And I don't want to sound pessimistic here, but this one company, Carriage Services, is very intriguing to me. And so here's their website, or here's their performance here. You can see that, year growth, it's about a 60% growth year over year. This has like tech-like growth numbers into it. And the other thing is, if you go to their actual webpage under investor, and this is kind of Warren Buffett-ish, if you think about it. First of all, it's a $25 billion sector. They have a 45% margin return, and their cash flow is doing really well. And we talked about small cap companies. This is what we want to look at. This is a real small cap company. But this is what I love about it. It's only one of two publicly traded companies in this particular industry group. And look where their funeral homes and cemeteries are located: California, Texas, Florida, North Carolina, and Tennessee. And this is kind of the Warren Buffett issues, right? They are in the sweet spot of where a lot of seniors are ending up. So this, I think, would be one of my better selections in that group. Okay? Fast and furious on that one. How about that, Thomas?
You rocked that one out, John. All right. We got a ton of questions, John. So let's try and rip through those. How does that sound?
All right.
We were going to talk about bird flu, but honestly, John, we had one confirmed death in bird flu. The reason I brought it up was Cal Sheep Prediction Markets, John, said that the odds of a bird flu pandemic being declared this year is about 25%, which is a lot higher than maybe I was thinking before I saw that. Any thoughts there, John? Or
yeah, I mean, I found out that we actually have a cash index. We can pull this up. This is the egg cash index, and you can see how well eggs prices have gone. So I think that first death was sometime in like November-ish or so. So is this a daily or a weekly? Okay. So yeah, you can see that since about October, egg prices have almost tripled. So I guess, this is a major inflation thing. I don't think this is something the Fed can do. But what was interesting is I went in here and I did compare. And so I just happened to, I've actually owned the stock on and off at times. And this is one of the largest egg manufacturers in the United States. And so here is Calm or Cal-Maine, and you can see that their stock has done very well with the increase of egg prices. But at some point, Thomas, if we do have an increase in bird flu, they're going to have to kill the chickens. So, if you don't have any chickens, you don't have any eggs. It doesn't matter what the cost of eggs is. You're not going to be able to sell them. But I would say if there's any other opportunity, if the bird flu does get a little bit more widespread, then I think we will see some opportunities in some of the vaccine manufacturers. And I did look it up. I went to the NIH website, and so Sanofi, GlaxoSmithKline, and Moderna are only the ones that have bird flu vaccines. So those ones might be beneficial if something more escalates. Okay. Did I lose you, buddy?
Hey, John, can you hear me?
I got you now. Okay.
Yeah. Your buddy Jim Van Meerten and bar chart contributor, he chimed in with his SPX year-end prediction, and he is saying 7,200.
Wow, Jimmy!
So I'm in the middle of John and Jim, guys. I'm feeling pretty good. I'm feeling pretty good about my number. I like where I'm at. Before I forget, I did tell people, John, I would show them this poll of what our ex-audience thinks about S&P 500. So we've got the majority, 33%, saying that's going to come in between 6,000 and 7,000. honestly, I would have thought it was higher than that. So again, I'm feeling pretty good about it being somewhere in that group, John. But we know we've got some numbers thrown all around.
Well, look at this: 50% are saying at current prices or below, though.
Yeah,
and Jimmy, you're
that's
less than 10% probably.
Jim. I think Jim probably likes that though, John.
Yeah, I do. I do too.
All right. So we got a question, John, asking with regards to change of character. They were suggesting that it's the other way around, that it's not a change of character yet, it's a break of structure. But I don't think so. I don't think anything has broken yet. I think
I don't think so either.
Market structure is still in place.
Yeah, if you look at, let's say, the S&P from a higher time frame, it's all about time frame perspective, right? Right? What is the market doing, right? Well, internally, inside of a weekly, it's making lower lows and lower highs. That's a change of character. A break of structure is if you break a previous high or low, depending on the dominant trend. Well, the dominant trend here is an uptrend, right? Even when we had these sell-offs here, we never really broke structure. That is really the key to a trend change.
Question is, do we think quantum is a threat to Nvidia? I don't think so.
No, I don't think so. I think the chips need to be made. I don't know where they're going to be coming from, or actually, when I was reading the article about, I did the research was about this. Even when quantum mechanic or physics computing comes about, it's not going to be like you're going to have a laptop with that's a quantum computer. This is going to be for very high tech, data driven industries like the biotech or utilities. That a lot of data is coming in, and they need to crunch it in a very short period of time, where the modern day computers would take eons, I mean, literally centuries, to do these calculations. So I don't even think it has like general public application. It's going to be still for a very select few people, but it certainly will help increase the way data is consumed and the way how data is presented, though.
I'm probably biased because I own Nvidia, John, but I feel like the only threat to Nvidia at this point is Nvidia themselves.
Yeah, I agree.
If they're unable to live up to sort of these lofty expectations that they have set for themselves, so they have to deliver in order to justify their valuation.
Right, or that their costs start going up and eats into their margins, or they make a mistake and they make too many chips and they're stuck with inventory. Before all this AI stuff started a couple of years ago, the semiconductor industry was, quote unquote, was in a recession because we had too much inventory. And all of a sudden, overnight, boom, now we don't have enough inventory, right? Okay.
Exactly. John, I think you touched on this very briefly in your opening segment, but how do you think the market will trend for the first half versus the second half?
Yeah, I mean, again, we're in this kind of this feels like this limbo where we're going sideways. And I think the market might be a little oversold in the short term, so I wouldn't be surprised on like a day-to-day or week-to-day basis. We might get a little bit of a bounce, but I think that maybe between now and, let's say, end of or mid-February, depending on what happens when the new administration comes in, there's a lot of risk in there. I already kind of mentioned those. I think the market is kind of probably going to drift lower or go lower during the first 6 to 8 weeks of the year, and then probably maybe sideways for most of the middle of the year. And then I think we'll probably, once we digest all the new, monetary, fiscal, geopolitical, black swans, whatever. Once all those things are kind of behind us, then I think we'll have a strong, end of third or going into the fourth quarter. I think that's where you're going to see a lot of your gains.
With the absolute strength in the U.S. dollar, John, if somebody is kind of fully concentrated with a U.S. portfolio, would it make sense now to go bargain hunting for international stocks?
Yeah. I mean, I'm not a big China fan, you know that, Thomas, but I said this to Thomas and one of my other producers, but you remember what I said to you, Thomas, about the dollar and looking outside of the U.S.?
I don't.
That if the dollar does weaken, I think there might be some opportunity in some Chinese stocks, right? Even though I'm holding my tongue on that one. But yeah, I mean, we looked at this, right? We picked these numbers out, these levels weeks ago, and here we are. We're right where we thought the dollar was going to go. I still think the dollar could end up going a little bit higher, but I feel like maybe this short-term run is over. Certainly, if interest rates continue to rise on the long end here in the States, that is going to make the dollar even more constructive or stronger. It's really wreaking havoc on a lot of other currencies around the world, not just the euro and the yen, but literally at all corners of the world. So, yeah, I think there is some bargain hunting to be found. I just don't know where that is right now. And I'm not going to buck this trend until I see a change of character and a break of structure. There you go.
John, do you think there's any opportunities for option sellers over the next couple of months while we consolidate?
Options. Oh, sell volatility. Yeah. What? I mean, I don't even know what the VIX is. I mean, the VIX is kind of low, isn't it?
I think it's may have spiked up to about 20 today.
Yeah. Yeah, I think there might be some opportunities as the market gets a little fearful, especially if we get closer to some of those more constructive support levels. I think that would be an opportunity to sell some volatility. But again, I think, in my opinion, in terms of the numbers of risk items out there, I think volatility is going to be a little heightened this year, which does mean that options will be a little bit more expensive. I just want to make sure that I manage that risk well enough,
Just a second, John. I'm scrolling through the questions to see what else we've got. Okay. How high, John, do you think interest rates can go, and what would the impact be on TLT?
Well, a TLT is already broken. Again, another ETF that we've spent a lot of time recently looking at, and we're kind of falling into this little gap here. So I haven't updated my chart in a while, but let's do this. Let's bring some of these higher lines down. So let's bring this one to right there. That's a gap fill. So we're in the gap fill. So that could be supportive to it. Certainly, I think, if we get into, we look at, let's see, this November low, October low, where was, let's say, the 10-year U.S., let's see, U.S., TY. Yeah, here we go. Where was that? And let's change this chart to a line chart. And I think what we'll discover is, we were close to that 5%, and we're getting really close to there now. So I still think that TLT is going to go lower. But at some point, we might get a reversal in yields. Now, the only thing that I'm worried about is a falling yield market. Yields might fall for the wrong reasons. In other words, money's coming out of the stock market because of fear of a recession, and they're buying these yields, pushing yield, like say push the TLT up, which would push down the yield prices. And I don't know if that's the scenario that we want, or what we need to really do see is inflation under control, and then I think the longer end. But really, the bond vigilantes here are telling us that long-term rates are going up, and it seems like to me all roads lead to inflation.
John, we've got one. This is going to wrap up the show, guys. One final question, which is there a potential cup and handle breakout on VST?
VST, that sounds familiar.
I think we've talked about this one before.
VST. Oh, Vistra, yes, of course. So this is like one of the second leading electrical companies or utilities they are an independent, so they're not a lot of regulations, regional regulations, so they've been able to benefit from the incremental demand for. So are they looking for a cup and handle on obviously not a weekly, we always start at a higher time frame. I think you could kind of make that case. You got a nice little cup here, and then you got this little, retracement. Let's go down a little bit lower time frame. Let's go to like an hourly. Let's see how that looks. Yeah, there you go. Yeah, nice job, whoever put that in. So yeah, here we go. Right, nice little cup. Found resistance. Right, here's where this should create a level of support, and there it is. Right, and now we're breaking out. So here's the clue. Here's the clue. What we're going to look for. Trading analysis. Let's go and look at our ATR. So our 9-day ATR is 8.8 and our 20 is 8.1. So let's say about 8.5. We go to the chart and we say, okay, well, this is the breakout right here. All right. So that is the breakout. So to get a confirmation, you want to see this go about $16 or at least $10.50, $12.50 above this breakout line to confirm that this is a breakdown. And I know that seems like a lot. It's almost a 10% move on this particular stock, but maybe you could lower that a little bit. But I kind of use that as my guideline on when I determine identifying potential breakouts. In terms of stocks, and this stock is definitely one of those stocks that has just been on a tear, and this is one of the stocks that we mentioned in our AI theme. And if you go back and look at our webinar that was in May on the grid, this is one of the stocks we featured in that segment.
Wow, what a show, John! I think we ran the gambit today on that one, John. I think we covered it all. We got.
I feel like I need another 3 weeks off.
Another 3 weeks and a shot of whiskey. John, we had a couple questions come in that are website related. Our support team will get back to you guys very shortly. If we didn't get to your question, it's probably because it's highly, highly stock specific. And unfortunately, John and I are not Jim Cramer. We don't know everything about every single stock out there. So, but anyways, guys, thanks a lot. We got a ton of questions, John, and I know you and I are extremely grateful for everybody coming and being engaged with the show. We really appreciate it.
Yeah, I do. I really do appreciate it. I love the folks, and I hope you guys are appreciating what we're doing for you. We're trying to give you the best ideas we can find, the best risk opportunities that are out there in the market. So until next time, the best of health, manage your risk, and the good of all trading.